Hey everybody, Frank Finance here. Hope you're having a wonderful day. Thank you so much for joining me. Today I want to talk about the combination of inflation and interest rates while investing and some of the things you need to be thinking about as the market progresses in the next year, maybe year and a half. And so basically I'm kind of be looking in that window. So this is more for short term, just trying to predict what's going to happen. Less important for long-term investors, obviously. Now, from current situation, we have relatively high inflation we haven't seen in many years, and increasing interest rates. We're currently going back several years now. I think home rates are above 5%. We have the Fed increasing by 0.5%, the Fed funds rate, and possible maybe two more of those here coming up within the year, and maybe a little bit higher than that. So maybe another 1.25, maybe a little bit higher than that. So the thing I want to talk about with that is asset prices. So we'll talk about stocks, we'll talk about real estate and crypto and bonds. Now, I don't talk a lot about crypto, but point is that it is another asset class that people are investing in, and I'll touch on it briefly. Now, for first off, stocks. Now, in the short term, they are down. Real estate is slightly rising and flattening, in my opinion. And crypto is down overall in the last, really the time frame is 3 months to 6 months. Crypto's down as well. And bonds are slightly up, mainly due to interest rates. Now, if you're thinking about stocks and these different asset classes and why they're going the way they are, looking at stocks and looking at bonds, they're basically flipped, right? As the yield increases on bonds, the value of stocks decreases, because the risk, basically the risk premium starts to decline between the two, right? You basically get the same amount of return on the stocks relatively to what you did before. And so you're paying slightly higher for bonds and slightly less for stocks because the risk premium isn't quite as high. Now, on the real estate, as we see increasing inflation, this is the thing that, in my opinion, is propping up prices at the moment because it's a hard asset, right? It's very difficult to, they can't overcome lumber prices. They can't overcome all these inputs into the housing market. And so that's kind of my prediction there. The thing with real estate prices is we start to see interest rates possibly going up anywhere, again, from 1.25, at least through the remainder of this year, possibly up another 2%. Now, that may be on the higher side. But seeing rates get to 3.25, 3.5%, I still think we could possibly see interest rates on very good folks who have good credit go around 7%, maybe slightly above 7%. I think there's a scenario where it goes up to 10%, but again, I don't think inflation is going to run that hot. But for too long, especially with these increasing rates, but we'll have to see that. I do think the interest rates will continue to rise. I know right now, probably 5 to 5.5 is probably what you're going to get. Maybe a little bit lower than that for folks with excellent credit. But for the average, you're probably playing over 5.25 right now. And if we see rates continue to rise, it's not a 1-for-1. So if we see interest rates rise by 2%, it's not like we're going to see real estate interest rates rise by the same amount, but it is a good indicator that those things may start to rise. And if we do see instability in that, you could see these mortgage companies needing to raise those rates to just hedge their bets on if inflation continues to go hot. On the crypto side, they are down in the short term. And honestly, I have no prediction for the long term, and it's mainly because it's just an unpredictable asset. There's no real cycle. It has not performed the way it's supposed to, theoretically. And so it can't really give a prediction to something that's actually never really been challenged this way. And they haven't acted the way they're supposed to thus far, at least in a short-term period. Now, from a bonds perspective, I touched on this slightly, briefly earlier. From a bonds perspective, they are slightly up, and that's mainly due to the increasing interest rates. Has very, very little to do with increasing inflation. And as bonds continue to rise, we'll see a decrease in stock prices, as we mentioned earlier. So if we start to see a slowing down of interest rates, we'll start to see that reverse on the stocks and bonds. Now, to touch a little bit on why that's important and why that happens, that relationship between stocks and bonds mainly has to do with a risk premium and the discount rate. So as I mentioned and I touched on earlier, the risk premium is basically the difference between a more risk-off asset versus a riskier asset. So relatively, if you're buying a good, forget AAA bond or whatever the non-junk bonds are, everything above a non-junk bond, it's going to be probably more secure than a stock. And so typically what you'll see is there's going to be the difference between the yield on the bond and the average stock. It's basically your risk premium. And so as bond yields start to go up and basically stock yields go down, that risk premium starts to shrink. And so you pay more for the bond, pay less for the stock. And also what changes here is your discount rate. So as the cost of debt goes up due to increasing interest rates or inflation or whatever it is, the discount rate, your cost of capital could go up. And what that causes you to do is discount your free cash flows back at a higher rate, which causes your company to be less valuable. And so those combinations is, in my opinion, why we're seeing stock prices go down in, also in correlation with, in my opinion, an almost impending recession. So we've seen at least one quarter now of negative GDP growth. I predict that more than likely, I'd say 90% chance we're going to see another quarter, which means we would have officially a recession. Typically, recessions are felt, they're kind of a lagging indicator more so than anything else, than a leading indicator. But the point is that more than likely, if a recession does occur, we'll continue to see stocks continue to slide. We may see bonds start to see a little bit of support and more interest there. But honestly, the bond market's been honestly not too great. We have seen treasury bonds doing decently well, I think. Real estate, again, has done phenomenal. Crypto has done nothing and delivered nothing to what it has basically said it was kind of meant for. As kind of an inflation hedge, as well as, mainly an inflation hedge. It's just not acting like that, like the asset class it's kind of pitched as. So those are my thoughts on combination of investing in a market with a high inflation and high interest rate or increasing interest rates. It's definitely a unique situation. We haven't seen this in several, probably a couple decades now. And so it's an interesting thing and a thought-provoking just to kind of go through there and what's probably going to happen in the 1-year outlook. So I hope you enjoyed this video. I had a fun time doing it. It's just kind of getting my thoughts out there for my subscribers. If you like this type of content, please consider subscribing. I do videos on personal finance, investing, and stock analysis. And my name is Frank Finance.